at stock markets, and let's understand where he makes things are headed in the short term, medium term, and the long term. Nilesh bhai, so good to have you back. Thank you for joining us. I was looking at data in the morning. Dow is down 14% this year. India is up 2% this year. Is this outperformance or decoupling?
Well, it is both. In the shorter term, flows drive the market. Over medium to long term, fundamentals drive the market. When there was outflow from Indian market, probably Dow and S&P outperformed our market. Now, when the flows have returned, certainly we are outperforming. The flows are driven by medium to long-term fundamentals of India. In the global sandstorm, we are truly oasis in the desert.
But the oasis in the desert means that you're still in the middle of a desert, which means the environment is
Undoubtedly,
messy.
Nikunj,
Yes, please.
undoubtedly, Nikunj bhai, inflation is 4 and 5 decade high all over the world. Geopolitical risks are heightened, and central banks who were supporting growth through easy monetary policy are now trying to control inflation by raising interest rates and cutting liquidity. Many countries are in recession, whether they accept it or not. So clearly, there is a sandstorm blowing, but compared to rest of the world, we are in a far better position. But that doesn't mean that sandstorm will not impact us.
So, what should be a asset allocation strategy or approach right now? There is a sandstorm, but you are in the middle of an oasis. Now you can feel happy that you're in an oasis, but the sandstorm will hit you.
In some sense, Nikunj bhai, have a core portfolio for medium to long-term growth story of India and keep a satellite portfolio which is buy on correction. In other way, balance between your fear and greed. When markets are in a tearing run-up, don't become too greedy. And when markets are falling, don't get too fearful. We believe global situation may put a cap on India's upside in the short term, but there is also downside protection because of our inherent medium and long-term fundamentals. So in a range bound market, buying on dip will work best for your portfolio.
Good morning. So just taking forward from what Nikunj was saying, we've talked about decoupling. We've talked, of course, about the outperformance. In the morning, we've been talking about the return of the retail investors as well. But Nilesh Shah, I want to ask you one question. We've been having certain guests on the channel and we've been asking them this. Do you think after 18,500 is conquered, the next one is going to be 21,000?
So, like Archimedes mentioned, give me enough space and a pulley and I will lift the earth. Give me enough time and give me any nifty target. I'm sure we'll be able to achieve it. There's no doubt in my mind.
There's no doubt in your mind that we will achieve any target that we have in time. Of course, the rule in the game is to never time the market, but to stay invested and make more money. Something that we like to educate all of our viewers here as well. But Nilesh, can I ask you one question? There's, of course, been a churn, the sectoral rotation that we've seen. There's so much that's been said about capital goods, maybe non-export oriented stocks. For you, where do you see the leadership? We've done with autos. Going forward, what will it be? Capital goods?
So we have been bullish on capital goods and industrials for some time, primarily driven by the fact that last 4-5 years they didn't have too much of order book. They all cut costs to become fighting fit. Now they have started receiving not only orders from the government as before, but also from private sector, which is redrawing their capital investment plan. They are also participating in exports market. And despite global uncertainty, many companies, by virtue of their parents abroad, by virtue of China plus one resulting into outsourcing, change shifting, they are all seeing increased exports. Valuation wise, capital goods were looking little expensive, but operating leverage coming in because of higher growth will ensure that valuation remains reasonable. So we still believe we are in a multi-year cycle on industrial and capital goods, and there are better days ahead for this sector.
Okay. Okay. Nilesh bhai, sorry for that pause. Little bit of it's raining in Bangalore and connections are slipping in Bombay. 5G should come early. What is the right way of looking at IT? One side we can say that IT has got rebooted because of the COVID crisis. That's a fundamental change in the way how digital and the importance of IT services will move. But on the other side, I can look at historical recessions and talk about how IT outsourcing and IT budgets have got crunched, whether it was 2000 or 2008. What is the realistic approach here?
So in IT, valuations were running up little ahead of fundamentals with small and mid-cap IT companies trading at a premium to large-cap IT companies. Now there is a growth reset happening. I think from low double-digit US dollar revenue growth, now market is expecting high single-digit US dollar revenue growth. My feeling is that in today's context, IT industry has already taken the cost push of salary hikes at the entry level. They have also readjusted to the low double digit to high single digit revenue growth. And over next 6 months, large cap IT will provide good accumulation opportunity. One can try to average over next 6 months. By then, revenue growth and cost push both would have priced in the fundamentals, and there after IT should be an outperformer.
Right. Slightly long dated kind of a question. In markets, they say catch them young and see them grow. Every theme, every decade will have 2 or 3 themes, which will be the outlier themes, which would be the large profit pools. And I'm establishing for our viewers here that we've seen themes like last decade we saw NBFC emerging as a big theme. Before that, it was private banking. Before that, it was IT. What is that big profit pool to your mind, which would be the differentiating theme for investors and for our markets for next 3 to 5 years? It's a question fund managers love it, don't they?
So Nikunj bhai, I believe there is renaissance coming in India's manufacturing sector. We have become back office to the world, and in certain select manufacturing sector like automobiles and generic pharma, we are globally competitive. We believe now this is likely to get extended into many other sectors. The primary driver will be growth in domestic market. Thereafter, it will be China plus one policy, where global supply chain management are looking to diversify out of China. We believe it can be converted into India plus one opportunity based on our domestic market size. Many of our peers have better infrastructure and higher competitiveness, but none of them have large domestic market like us. Put together, we believe there will be renaissance in manufacturing sector, and what happened in automobile and generic pharma will get repeated in many sectors. This could result into higher percentage profit growth. The entire manufacturing sector may not have high absolute profit compared to, let's say, banks and financial services, but in terms of percentage profit growth, they should rank right in top 2, 3 sectors. and there is little bit of under ownership in this sector. You can get not only local market oriented companies, but also global exports oriented companies. Put together, the percentage profit growth in manufacturing sector could be one big theme for next 5-6 years.
Great to hear that, Nilesh, and always good to get in your perspective as well.